Hello, my name is Brian Overby. I'm known as the Options Guy, and I'm the author of the Options Playbook. Welcome to Options Guy TV. Okay, so we're in the middle of earnings in a lot of the major companies coming out this week. I am going to start right away by just showing my Trade Hawk software here. I put a list up of earnings that I thought were going to be interesting this week. I always like to look at ADP's earnings. Usually, I'd like to listen to their earnings call. Have a lot of interesting things to say about payroll, and usually just gives you a little bit of a hint on the jobs front as to what's going on in the industry. And then we have Alaska Airlines, we have Boeing, Cleveland Cliffs, we have a couple of oil companies. Ford actually will be announcing this week, but they had major news last week. Looks like it actually made a pretty good pop up after the news saying that they were going to lower their price on their EV vehicles, in particular the Lightning, their Ford truck, their EV truck. First Solar, Google, and then of course we got Google and Meta. Those are the two big players that are going to be announcing this week. Microsoft's right in the middle, part of the Magnificent Seven. Like to talk about Snap a little bit, just look at what's going on in the advertising front. Obviously, Google is pretty big as far as advertising is concerned also, but I think it's a cleaner picture when you're looking at Snap, at ad revenues and stuff like that. I don't find it a very interesting company that I want to really trade in, but I always like to listen to it. We got the VIX index. Oops, that's not it. I'm looking for the VIX. VIX is right around 13. I got it up here rolling on my screen. We got Visa, MasterCard, I think, is also announcing this week. VIX, there's the VIX at 1381. And then ExxonMobil. So a nice strong day again in the markets. We talked a lot about last week that over the last 7 quarters or so, around earnings, we've seen a decent spike up in the S&P 500 index. Now we're getting a little frothy in the marketplace, but we're into the second week of this earnings season for this quarter. And we're going to do a little bit of a rinse and repeat compared to last week, but I do want to throw a twist in it. Last week, I think we were a little bit more bullish at the beginning of the week than I would say that we would be now, mainly because we had such a strong week last week. You're a little bit worried about a pullback in the marketplace, just because things just don't have a tendency to go straight up, even though the market right now seems to want to. So let me go and pull up my market watch list here in my TradeHawk software. And we'll see the Dow is we're a little bit flat across the markets. The Russell's down a smidge. SPX is up 0.39%. Not a bad move in the SPX. Russell flat. NASDAQ up less than 0.1%, up 14 right now. And so hopefully we can keep this trend going. So let's start this week, much the same that we did last week, where we're going to enter a trade. It's going to be considered a paper trade. Nothing's ever meant to be a recommendation here on Options Guy TV. We're just trying to learn. But I do think it's time to do a rinse and repeat strategy where we did a long call spread in the S&P 500 index last week. We're going to take that concept and I'm going to compare it to just buying a long call. Now, last week, the long call would have done better than the long call spread because we made such a strong move to the upside, basically a 1 standard deviation move if you looked at the volatility. And so this week, we will compare a long call and see how that trade will do and set up the long call, very similar to the way that we would set up the long call spread. The long call spread and the way that we approached it last week is something that I like to do in the indexes. I like to try to set up a debit spread where I am paying I'm paying less time premium than I am buying. So 1 second here, let's go and take a quick peek just there. All right. And I'm going to set up what I really want to look at on my charts, and I'm going to do this real quick, like inside the TradeHawk software, is I want to look at what the what the extrinsic and intrinsic value is on the charts. So when we look at this, we're going to try to make sure we're selling more. We're selling more time premium than we're buying. So when we look at the trade, so 1 second, let me get this set up. All right, and now let's share my screen. And here we go. So the first paper trade that we're going to have this week, we have the S&P 500 index at 4,552.43. It's up $16 on the day. We're going to be buying the just in the money strike. So we're highlighting in the trademark in the trade hawk software, we're highlighting the most at the money option contract. So that's actually the contract that we're going to be looking to sell. We're going to look at the July 28th expiration. This is going to live 1 week. And we are then going to buy the 45.45 strike and then sell the 45.50 strike. So here's the ask, here's the bid. If we're buying, we click on that. It's going to put it down here. Here's the bid. If we're selling, we click on that. And that would give us our spread in our order ticket on the bottom half of the screen. Right now, we see that it's a $2.80 debit. If we did this spread, we want the market to stay above 45.50 on that trade. So if you do the math right now, it's 45.51, which means that if the market doesn't move, it's above 45.50. We got a lot of fives going on here today, so it makes it real fun to talk about the S&P 500 index. All right, so if we stay where we're at or we continue higher, this trade would be profitable. As a matter of fact, it could even come down a little bit. If the mark is right at 280, and notice that our limit price isn't changing, but you're seeing the real-time quote adjusting up above. We're going to try to trade somewhere during the mid. This will be considered our paper trade this week. But at 280, if you take that and add it to the 45.55 strike, that's the one we're selling, 45.50 strike, and add 280 to it. That means that we're at 45.52.80. 45.52.80. That's going to be our break-even point. So that's where the market could come down to, and we'd still be at break-even on this trade. So how do we pull that trade? How do we pull that scenario off? How are we able to do a debit spread and be favorable time decay? So we addressed this a little bit on Friday's show, but I have a chain now set up with intrinsic and extrinsic value as far as the option is concerned. So if I'm looking at the extrinsic value on the 45.50 call, we see that we have, or the 45.45 call, we see that it is $7.24. On the 45.50 call here, we are selling, we're intrinsically worth $2.16. So we're just a smidging in the money. So we have more intrinsic value on the 45.45 call than we do on the 45.50 call. Now that makes sense as far as call options are concerned. So now let's look at the time value, or on our charts, it's referred to as intrinsic value. It's cracking me up with all the fives. It's kind of hard to get through these strike prices in the S. And maybe I should have did this in the SPY because it would be a tenth of the value. But here's where we're at. So on the extrinsic value, on the time value, we see that we have 25.10 in time value. We have more intrinsic value, but the time value of the one that we're buying is quite a bit less than the time value of the one that we're selling. We're selling all that at the money option contract, and that's where all the juice is at. Now, notice that as you go further down in strike, intrinsic value goes up, but time value goes down. And that's also true as you go further out. Obviously, on out of the money options, they're going to be trading for less, which means you have less time value. But usually, if you go equidistant in and out of the money in a theoretical world, you're going to always have about the same amount of time premium in the money option contract, equidistant to the out of the money option contract. Okay. So let's say right now we're at 45.54. The market is going up. So if we go down 20 points from this would be the 35 strike, right? So on the 45.35 strike, we have an option contract that's trading for about $40 on the bid. But all I really care about is the intrinsic value. That's trading at about $20, right? $20, and we'll call it 50 cents. The market's really moving right now. So if we go 20 points out of the money from the 55 to the 75, notice we're trading close to $20, a little less. We're trading right now right around 19% implied versus $19 versus $20. So a smidgen, but almost the same amount of time value or of extrinsic value. And that's just the way that options work. Now, there's a skewing in volatility in the real world, and that if it was a theoretical world, those option contracts, if they're both equidistant out of the money, should be trading for the out and in the money, should be trading for the same time value. So that's a lesson on setting up long spreads. And the only reason why I'm doing a long spread most of the time is because I want to manage time premium. So I need to understand when I'm setting up my long spreads, how time premium is going to affect my trade. So in this instance, on our trade that we have set up, and the market's already moved up in our favor on the trade. But if you look at this, we see the 45.50 and the 45.55. The difference in time value is a couple of dollars, and that affects our break even. That affects where we need the market to go in order for this trade to be profitable. Okay, so this is going to be the official paper trade. It's a rinse and repeat of last week. We need the market to either stay where it's at or continue on up. And we're in the middle of earnings season. We had 11% of the S&P 500 index that announced last week. I don't know the exact number that's announcing this week. But if we look at, we got a lot of big dogs that are announcing this week, and I've highlighted a few of them there. Google, Meta are probably the biggest ones that we're going to be looking at. And then next week, we're going to have Amazon. So a lot of times Google announces the same week as Amazon does, but that's not going to be the case this time around. Amazon always does announce on a Thursday, at least for many, many, many years it has. So on Wednesday, when we come back, we'll look at this trade. We'll also look at a trade in one of the stocks that are going to be announcing earnings. Just interesting to always look at the pricing dynamics and learn something about how the markets move with implied volatility movement and also time decay. But I also want to leave you with one other option this week. We're going to do two trades today. And that second trade is just going to be a long call. So I'm going to pull up my website actually right now. Let me move this just a little bit. Go ahead and then go to the big picture. There we go. And let me take this down. And I'm going to pull up these two strategies. Now, this is the book that I've authored, the Options Playbook, and we can share my screen now. And what we're going to compare here, I guess we're not sharing that one. All right. Let me share 1 second. I'll just keep it up and running. I think we'll just ride with it this way. What we're going to compare is what a long call spread, how the dynamics and how we would pick out a long call spread relative to an actual long call. Last week, the long call would have did better. So this week, we're going to actually pull it up and look at that long call. So 1 second here. Let's go and get rid of, on my screen, I'm seeing something different than you are, but I will bring up the TradeHawk software. Okay, so if I'm looking at a long call and I'm speculating on a move, last week we were fairly bullish on the market just because of all the things that we had talked about. This week, I am also bullish. I'm just a little bit more trepidatious, only because we've had such a strong run to the upside. We're going to stay in the same expiration, but to be blunt, if I was buying a long call, I would probably go a little bit further out than this Friday. They're going to be expensive, but right now we are in the July 28th expiration, and we have 4 days remaining until that expiration. So I'm going to pay attention to how far out of the money I want to go on my long call. So in order to do that, I'm going to change up my chains a little bit, and let's go back to we're going to go back to my delta chain. And if we look at the delta of these option contracts on the expiration that goes out only 4 days in time to the July 28th expiration, we're going to be looking at buying something that has a decent amount of delta, but they're going to be expensive if we buy a lot of delta. So on our long call spread, we're spending $280. So in order to get that amount, we got to go all the way up to beyond a 1 standard deviation move, looking at a delta of only about 9 or 10 on this. So that means that if the underlying market goes up $1, we'd expect this to go up 9 cents or 10 cents if we're looking at these option contracts. So that's a little bit too cheap for me. Unless I really think it can make more than a 1 standard deviation move, I don't want to buy those option contracts. I want to buy an option contract that has the potential to get in the money. Now I want to not be cognizant of the cost. So where do I want to be? I want to be somewhere right around that 25 delta. It's going to be a lot more expensive, and I'm going to have to manage my risk a lot more. But if I see this 25 delta option contract, let's clear out these. And this will be the second paper trade this week. And we're just going to compare it. So here's the delta right around 25. I click on the ask. And if the market does go down, we'll make an adjustment on this trade. We'll roll into a call spread. We'll do something to try to battle off the time decay. The one good news of buying this out of the money option contract is that the VIX is a little bit lower. The VIX right now is trading at right around that 13% level. I think it's a little low relative to where it should be in the marketplace, but the market knows best. So I don't mind speculating on an out of the money option contract, but I'm going to watch it a lot closer, and I'm going to be ready to make my adjustment. And if I was going to make an adjustment, I'm going to be looking to roll into the long call spread, and that would be if the market went against me. I want to try to manage some of that risk. So right now, if we look at the 40, let's say 46.15, right? That's 10 points out of the money. That's trading for $7 on the ask, $7.40, on the bid, $7.20. There's two ways that I can approach this. If I sell that trade right now, we're going to have an inexpensive trade in my account. But if I see this get cut in half, this is the strike I want to sell to try to protect myself. If this gets cut in half, let's say it's trading for $3.80, right about that price. I wouldn't really care about where the market is at. The market has obviously gone down. I want to bring in enough premium to make it worth my while to protect my long position. So a lot of times when I'm doing this, I'm just watching that option contract. And if it gets to a level where it's worth selling, right? But it's not zero. So about half of this value where it's at right now, that would mean the market's probably down. Let me see, the delta on that is a little. So we're probably down 30 points or so in the S&P 500 index. And if that does happen, then I'm going to sell that option contract. So I'm totally looking at the price. This is the strike that I want to own because I want to be able to get my money back if the market does move. So now if the market comes all the way back, I started for $9.90, bring in another $3 or $4. My maximum for the trade would be $10. So I want to be cognizant of what my adjustment would be and how that would look on that trade. Okay. Sorry about the fives today on the strike prices. But with that said, I am happy to go over anything that you may have a question on. If you put it in the comment box on YouTube, we will try to address that question now. So if you have any questions out there, please let me know. And I will go back and talk about the two trades today, do a small little summary. Okay. So the first paper trade was a rinse and repeat of last week. If you'd like to understand everything that was behind that trade, feel free to go back and watch last Monday's Option Guy TV. This week, we're going to do something similar. I just went into more detail on the extrinsic and intrinsic value and how the pricing of those option contracts work. So to go along with it, somebody asked me, well, why didn't we just buy a long call last week? And that's a great question. Only because we didn't. That would have been a better strategy, but I did not obviously know that we were going to make a very strong move to the upside in the S&P 500 index. So we're going to look at if the market goes against us. And once again, sometimes, we're just trying to learn here on Options Guy TV. Sometimes it's better if we do get the market to go against us so that we can look at an adjustment in real time on the trade. But if the market goes with us, we'll also talk a little bit about it. We talked more about how we would adjust our long call in this scenario, why we set it up. If you go out further in time, you would have to pay more for that option contract, but you would actually get a higher delta. As you go out further and further in time on the same strike price, you will end up with more delta, which means you pay a little bit more, but you get a little bit more reaction to market movement. And then you get a little bit slower theta. So I usually want to err to going further out in time because I'm going to react to the market and I'm going to adjust the trade. I'm not going to ride this thing all the way to expiration. Only way I'm going to do it is if we get that strong move like we did last week, then there would be no reason to have to adjust that trade. Okay. So at the money long call spread, out of the money long call, we're going to have a battle this week. And we're going to see what trade does better and talk about the dynamics of both. We'll be back this Wednesday at 11 a.m. for another edition of Options Guy TV. If you have any questions, put them in the comment box and I'll try to address them right now. I already see we have one in there. Okay, what is the amount for a standard deviation in the SPX? Well, this is one thing that's wonderful about the TradeHawk software. There's a couple of ways that you can find what a standard deviation is, and that's a great question from Max. So if I look at this, we're on the July 28th. There's 4 days. If I'm going to click on this, because I'm learning the software. Our inaugural show was last week in Options Guy TV. But I can look at the expirations and it will show me, 1 second here, somewhere. A 1 standard deviation move. So if I click on shading and I click on 1 standard deviation move, based off of the strikes, the TradeHawk software will give you about a 1 standard deviation move. Now, another way to do it is to look at what the delta is. So the market right now is 45.60. The delta on an option contract that's about 1 standard deviation away is going to be fairly close to 16. So we know on the upside from 45.60 to about 46.25, that's about a 1 standard deviation move. On the downside, we're going to look at the same scenario, but we're going to look over at the put. Right here, it's right around 17% implied volatility. Well, it's between 15 and 17. It's not an exact science because you're dealing with strike prices. But in that instance, that would be about a 1 standard deviation move. And you note that it is highlighted. So it's 44.85. One big thing to note is that it has no regard to direction. We're taking the implied volatility number of the options, and I'm going to highlight that right here on my chart. And based off of that, we're coming up with over the next, this option contract is a shorter term one, right? No, we're in the July 28th expiration. Okay. Highlighting it there. So over the next 4 days, this is highlighting what the potential 1 standard deviation move would be. And that actually adds, and that was a great question, Max, because what that actually adds here is it kind of highlights that I'm buying something that's in the middle, right? Here's where the market is at. I'm looking to buy something. If we do get that strong move to the upside, we're going to blow through that strike and continue on up. So I would prefer to buy something where I think it can get to that strike and go beyond. If not, I don't want to buy that option contract. I'm just not buying a long option. I'm going to do something else. It's that simple. So I'm not going to buy the 4630. Why? Because that's my target. That's where I think it may get to. And so in that instance, we're going to run into actually a little bit of problems right around the 4600. But in this instance, if I'm looking at doing this trade, I do not want to buy that option contract because I need it to blow through my strike. I needed that acceleration of that option contract getting in the money. Okay. Under what market circumstances? Oh, next question. Here we go. Under what market circumstances would you consider doing a credit spread instead of a debit spread? If I were, one of the reasons why we're looking at debit spreads, one of the reasons why, even though we're selling a little bit more time premium than we're buying, is that we got the VIX at a low level relative to where it's been over the past year. So there's not a ton of volatility in the marketplace. And I think that it's a little bit overdone on the downside now, as far as the VIX is concerned. So if I go back and look at, let's say, even 6 months ago, I would have been more apt to look at selling a credit spread to get bullish or bearish on the market, as opposed to just buying the long call spread outright. I just think that the conditions are right. And that's what the options playbook is all about, is there's a plethora of different strategies. And I always like to say there's no golden book of answers. You just want to look at what's going on in the market and then decide, is this something that what strategy would apply based off of the current market conditions? And we just got the VIX a little bit lower. So I'd rather do a long call spread at this point in time than go out trying to just sell premium. I think that the potential strong move to the upside or the downside is possible. And if that is possible, I'd rather be long option contracts than be short option contracts. All right. Well, it looks like we're right at time. So with that said, thank you for coming today to Options Guy TV. We'll be back this Wednesday at 11 a.m. for the next edition of Options Guy TV. Please click subscribe, ring the bell, and give us a thumbs up if you could. That helps us out a lot with the show. And we'll see you this Wednesday. Thanks for coming, everyone.